much working capital does a small business need? Working capital might mean different things to different business owners. As the name suggests, working capital means the amount of money needed for the task in hand to progress. Depending on the industry and management style, companies need to realize how much working capital their business needs to unlock new growth opportunities. Learning to manage the working capital is necessary to ensure financial health and improve daily business operations. Although large businesses can function with negative working capital, they can quickly raise funds. Small businesses have to maintain a positive working capital figure to ensure smooth functioning. Generally, the amount of working capital needed by a small scale business to function depends on a type of business, operating cycle, and the owner's future business goals. Before we understand the concept of a working capital, you need to first look at the definition of balance sheet, shareholders' equity, assets, and liabilities. What is a balance sheet? Balance sheet is a financial statement that reports a company's assets, liabilities, and shareholder equity at a specific point in time. Assets in layman's terms are the profits and liabilities are losses. Shareholder equity means the percentage of share of the company's net worth that needs to be returned to the shareholder once a company's assets are liquidated and all debts are paid. For example, if the assets of a company are 50 lakh rupees and the liabilities or the debts are 18 lakh rupees, and if the shareholder percentage is 10%, then the amount that needs to be returned to the shareholder as their equity is 10% of 22 lakh rupees, which is 2.2 lakh rupees. Check out the simple example below for further understanding. What is a working capital? Working capital refers to the difference between a company's current assets and liabilities listed on its balance sheet. The items included in the current assets are savings account, checking accounts, marketable securities like stocks and bonds, inventories, etc. It is a list of things that can turn into cash in the next 12 months. The items included in current liabilities are rent, cost of material and supplies, taxes, utilities, and short-term debts. This is the list of costs and expenses that the company incurs within the next 12 months. The working capital of a company is a measure of its budget management and operational efficiency. For example, a business with a negative working capital, more liabilities than assets, will find it difficult to meet financial demands rather than a business with high working capital. Key factors that determine a business's working capital: business type, operating cycle, management goals. Business type. Some businesses, such as those involving physical inventory, need a higher working capital than others to function smoothly. Also, some businesses are seasonal, which means they need a very high working capital to ensure maximum production. For example, department stores need to increase inventory and staffing to meet the increased influx of customers during festive seasons. Businesses such as software providers and online consultants who provide impalpable services can get away with low capital. Businesses that have matured and growing anymore also have reduced working capital demands. Operational cycle. In an ideal situation, a business can pay off its short-term debts with revenue obtained from sales. However, companies that take a long time in creating and selling products will need more working capital to meet its financial obligations in time. Some businesses bill customers after providing services. These companies also need higher working capital to prevent financial problems as a result of late payment. Ensuring the organized operation of a company's operating cycle will help to maximize the yield on current assets, invested and minimize spending. Management goals. This is another important factor affecting the need for working capital. If a small business aims to expand and grow, higher working capital is needed than a business that plans on staying small scale. Businesses that plan on expanding product lines, entering a new market, etc., need to have the high working capital to meet the costs of research, design, development, etc. How much working capital does your small scale business need? Theoretically, a company should maintain a positive working capital ratio, WC ratio, which is current assets by current liabilities. However, a ratio of 1.0 is also good enough to meet short term expenses. Apply the WC ratio in your business to determine whether it is positive or negative, below 1. If it reaches around 2, it means you have cash available for investments and potential growth. According to the recommendation, a company should have 1.2 to 2.0 for reliable financial health. A ratio of greater than 2.0 can mean that the company is not maximizing its excess cash and assets through investment and is a red flag. In case a negative WC ratio, first, you need to identify the root cause. It might be high expenditure or poor marketing. Now come up with a plan to reduce expenditure, improve marketing, boost sales, or generate some capital influx in your business. A good WC ratio is necessary to ensure the smooth running of your business. High working capital will enable you to invest and boost your profits. Generally, taking a small business loan can help you overcome logistical hurdles, keep your business running smoothly, and cover most short-term obligations. Nowadays, most small business owners are turning to strategic lending options to make the most of longer-term investments. According to Forbes, the loan opportunities for small businesses are rising rapidly, providing more access to working capital. Hence, properly borrowing and managing money along with strategic planning can help you reach your goals.